And I guess if there's a theme, overall theme, a single theme that runs through today's restructuring market is that value is increasingly being redistributed before bankruptcy rather than inside of it. 10 years ago, if we were sitting here, we'd be talking about what I'd call capital R restructuring. So you're a company, you file for Chapter 11, you maximize your enterprise value, you implement hopefully some sort of operational restructuring changes, and then you ultimately hopefully make the pie larger for everyone. Today, we need to focus just as much, if not more, about what happens beforehand through an LME that can dramatically change, alter recoveries long before that petition is ever filed. And even once the company enters for Chapter 11, and we're going to talk about that sort of in the latter half part of this discussion, many of those same dynamics continue through debt financing, release provisions, or all over disputes over priority and collateral ownership. So the LME landscape today, as was said here before, you probably need to start thinking about this at least a year or two before Chapter 11 filing takes place. You've heard of them as lender violence, but the reality is that they have fundamentally changed the way that the restructuring landscape plays out today. And the roots obviously trace back to the borrower-friendly documents of the early 2010s. They, in sort of years of low interest rates, that the intense competition among lenders gave rise to these increasingly flexible documents that that gave fewer covenants, broader baskets, that gave companies, as the companies became distressed, they gave them opportunities to reshape their capital structure without going into court. In 2015, only a handful of distressed exchanges were out of court, and now by 2024, well, more than 50% of them were out-of-court exchanges. At its core, what a company tries to do is extend the right-of-way, raise liquidity, avoid that immediate Chapter 11 filing, though ultimately most of those companies do end up in Chapter 11. And then from a participating lender's perspective, the hope is that you're improving your position in the capital structure, and even more so once the company files, you are likely going to be in a better position to up your recoveries. And from an excluded lender perspective, you are losing value, most likely. You're losing your priority and collateral rights. But then if you talk to commentators in the space, if you talk to judges, specifically, particularly bankruptcy judges, it's really viewed more than anything as just kind of, I mean, the term you hear sometimes, you're arranging the chairs on the Titanic. But what's become more and more the case is that it really feels like it's almost a required step before Chapter 11 these days.